Alfonso Cahero, A Journey into Finance History, Chapter 59, Oil Price Crash, 2014. A significant decline in oil prices impacted economies worldwide. In the vast expanse of the Arabian Desert, a kingdom built on the wealth of black gold gleamed under the sun. Saudi Arabia, with its towering oil rigs and sprawling refineries, stood as the titan of the oil industry. It was the summer of 2014, and the global oil market was seemingly stable. Prices hovered around $100 per barrel, and economies worldwide were fueled by this liquid treasure. In Riyadh, the capital of Saudi Arabia, Crown Prince Mohammed bin Salman sat in a lavish palace, contemplating the future. Young, ambitious, and driven by a vision for his nation, he understood the dependency his kingdom had on oil. The streets of Riyadh buzzed with life. Luxury cars roared through the streets, and opulent malls catered to every whim of the affluent. The nation was thriving, but the prince knew that this prosperity was fragile, built on the shifting sands of global oil prices. Across the ocean in Houston, Texas, the heart of America's oil industry, there was a similar sense of complacency. The shale revolution had turned the United States into a leading oil producer, challenging the dominance of traditional oil giants. Jim Carter, a seasoned oil man with decades of experience, watched as rigs dotted the landscape, extracting crude from the once unreachable depths of the earth. The industry was booming, and the future looked bright. Yet beneath this surface of stability, a storm was brewing. Geopolitical tensions, technological advancements, and market dynamics were aligning in a way that would soon disrupt the entire oil market. The stage was set for a dramatic shift, one that would send ripples through the global economy and touch the lives of millions. In Moscow, President Vladimir Putin observed the situation with a wary eye. Russia, heavily reliant on oil exports, enjoyed the revenues that high prices brought, but the whispers of an impending change reached even the Kremlin's fortified walls. The nation's budget, military strength, and political stability were all tied to the fortunes of oil. Meanwhile, in the bustling markets of Beijing, China continued its insatiable demand for energy. The nation's rapid industrialization and urbanization had turned it into the world's largest energy consumer. Chinese leaders, ever strategic, sought to secure long-term oil supplies to fuel their economic juggernaut. As the sun set on another day, casting long shadows over the oil fields and refineries around the world, an invisible clock ticked closer to an unprecedented event. The oil price crash of 2014 was imminent, poised to shake the foundations of economies and industries alike. Little did the world know, but the forces of supply and demand, coupled with political maneuvers and technological breakthroughs, were converging. The days of high oil prices were numbered, and the calm that enveloped the oil markets was about to be shattered. In the coming months, the characters in this global drama would face challenges and decisions that would define their futures. From the halls of power in Riyadh and Moscow to the oil fields of Texas and the boardrooms of Beijing, the impact of the oil price crash would be felt far and wide. The story of 2014's oil price crash is one of ambition, resilience, and transformation. A tale of how the world was forever changed by the fluctuating fortunes of black gold. As autumn approached, the first signs of trouble began to appear in the global oil market. Reports from various parts of the world indicated a growing surplus of oil. Technological advancements in extraction methods, particularly the shale revolution in the United States, were leading to an unprecedented increase in oil production. The balance between supply and demand, which had maintained a semblance of stability, was starting to tip. In Houston, Jim Carter received a report from one of his field managers. The numbers were staggering. Shale oil production was soaring, and new wells were coming online at a pace that was hard to keep up with. Jim's company, like many others, had invested heavily in fracking technology, unlocking vast reserves of oil that were previously thought to be inaccessible. The industry was riding high on this wave of innovation, but Jim couldn't shake the feeling that the market was becoming saturated. Meanwhile, in Riyadh, Crown Prince Mohammed bin Salman convened a meeting with his top advisors. The young prince had ambitious plans for Saudi Arabia's future, encapsulated in his Vision 2030 initiative. This plan aimed to diversify the kingdom's economy away from its heavy reliance on oil. However, the immediate concern was the falling price of oil, which threatened to derail these long-term goals. "We need to understand the full impact of this increased production from the United States," the prince stated, his voice steady but filled with concern. "Our revenues are at risk, and we must be prepared to take decisive action." His advisors nodded in agreement. They knew that Saudi Arabia, as one of the leading members of OPEC, Organization of the Petroleum Exporting Countries, had significant influence over global oil prices. But wielding that influence required careful strategy and coordination with other oil-producing nations. In Moscow, President Putin was also receiving alarming reports. The Russian economy was heavily dependent on oil exports, and any significant drop in prices would have severe consequences. The Russian president, known for his strategic mind and steely resolve, called a meeting with his energy ministers. The Kremlin's grand halls echoed with discussions about production levels, market strategies, and potential alliances. "We cannot allow our economy to be destabilized," Putin declared. "We must find a way to counter this surge in production from the United States. It's not just about our economy, but our position on the global stage." As these high-stakes discussions took place, the oil markets began to react. Prices, which had been relatively stable, started to show signs of volatility. Traders on Wall Street and in financial hubs around the world watched closely, sensing that a major shift was underway. The first tremors of the impending crash were being felt, and the anxiety was palpable. In Beijing, Chinese officials observed the developments with a mix of concern and opportunity. China, as a major consumer of oil, stood to benefit from lower prices. However, the long-term stability of their supply chains was also a consideration. The nation's leaders began to explore options for securing their energy needs, including investments in alternative energy sources and strategic reserves. Back in Houston, Jim Carter held a meeting with his senior team. The mood was cautious, and the room was filled with charts and graphs showing production forecasts and market trends. "We need to be prepared for a downturn," Jim said, looking around the table at his colleagues. "Our strategy must adapt to these changing conditions. Let's focus on efficiency and cost management. We can't afford to be caught off guard." As the days turned into weeks, the tension in the air grew thicker. The oil price crash of 2014 was no longer a distant possibility. It was becoming a reality. The world was on the brink of a significant economic event that would test the resilience of nations, industries, and individuals. In the heart of the Arabian Desert, under the neon lights of Houston, within the Kremlin's fortified walls, and across the bustling streets of Beijing, preparations were being made. The players in this global drama were bracing themselves for the impact, knowing that the decisions they made in the coming months would shape the future of the oil market and beyond. November 2014 marked a turning point in the unfolding drama of the oil price crash. As the world watched, the price of oil began to plummet. What started as a gradual decline turned into a steep freefall, sending shockwaves through global markets and economies. In Riyadh, Crown Prince Mohammed bin Salman sat in a high-stakes meeting with OPEC leaders. The room was filled with tension as representatives from oil-producing nations debated their next move. The young prince knew that Saudi Arabia's response would be crucial. Some members pushed for production cuts to stabilize prices, while others, wary of losing market share to the United States, argued for maintaining current levels. "We must think strategically," the Crown Prince stated, his eyes scanning the room. "Cutting production might give short-term relief, but it could also concede our dominance to shale producers. We need a more nuanced approach." The debate was fierce, with national interests clashing and economic realities bearing down on the delegates. After hours of intense negotiations, the decision was made. OPEC would maintain its production levels. The hope was to pressure higher-cost producers, like those in the United States, and reclaim market share in the long run. Meanwhile, in Houston, The impact of the falling prices was being felt acutely. Jim Carter's company, like many others in the shale industry, faced a harsh reality. The break-even price for many shale operations was significantly higher than the current market price. Rig counts began to drop, layoffs loomed, and the sense of optimism that had pervaded the industry just months before was rapidly fading. Jim gathered his team for another critical meeting. The atmosphere was grim, the weight of the situation evident on every face. "We're facing tough times," Jim began, his voice steady but tinged with urgency. "Our priority now is survival. We need to cut costs wherever we can and focus on our most productive wells. It's going to be a rough ride, but we'll get through this if we stick together."